And our goal is to build 4 or 5 companies a year. Now, we also don't only do B2B. We also have done and do B2C companies.
And you end up with 15-25% in each company, right?
Probably about 18%. Let's work with big companies to really identify and validate problems that they have, or more specifically that their customers have, is typically what we were doing. I think what differentiates us is the flexibility in our model. Moved ourselves to a lower equity stake. Not always, but typically we start with a solo founder. And then our goal is to try to get the company, an MVP built, and get the company in market with its first few customers, let's say, within 6 months. The services we provide, really everything from 0 to 1.
If you are supporting them, do they pay you after this 6 months? No, also no.
No. Awkward to give somebody money, but then require them to give you some of the money back. And so they raised about $6-7 million, I think. And then they exited last year. About 12 million raised, remaining open to opportunity.
We've hosted already 5 online conferences for venture studios, VCs, and family offices. And I'm inviting you to join our paid community called Venture Studio Family. If you are a venture studio founder or a representative or a manager of a venture studio, you want to learn the best practices and know how different venture studios operate. So you can find the best ways on how to attract founders, great founders to venture studios, or how to create successful companies with not superstar founders. You can learn how to fundraise into your studio fund, or into your startups created in the studio. You can learn how to create sustainable studio, which has cash flow and which can be not dependent on external venture capital. You can find the best ways to manage the studio if you join this community. So check the link, Venture Studio Family, in the description, and join the community of about 30 venture studios. Ben, very happy to have you on my podcast about venture studios and startup studios. First question, can you tell your story how you have come to this model, how Highline Beta started?
Sure. Yeah. Thanks for having me, Max. My background is in the tech space for the last 26, 27 years. I started my first company in 1996. It was a agency business, not surprisingly, early days of the web. Started a couple of other companies, joined a startup in 2010 called Go Instant, which was acquired by Salesforce. Started angel investing. Even before that, I'd started something which at the time we didn't call a venture studio, called Year One Labs. And Year One Labs, we started in 2010. We built 5 companies from the earliest stages. From idea, we were matching founders. We put in a very, very small amount of capital, and we were applying lean principles to try to get those companies out the door. This was right when lean startup was emerging. And one of those companies ended up being acquired by Airbnb. The founder of that company was, or one of the founders was Lenny Rachitsky, who then went on to do Lenny's newsletter and is done some incredible things. So that was the early experience of trying to build companies from scratch. And then connected with my co-founder, Marcus, 7 years ago to start Highline Beta. I had recently left a startup where I was running product, wanted to start another company. I was sort of ready to start a company, wasn't sure what kind of company to start. And somebody said, and I knew Marcus, and somebody said, oh, you should talk to Marcus about what he's doing. So the two of us got together and realized, we really enjoy investing at the earliest stages, at day zero. So we love investing. That's even before pre-seed, but we love investing in companies, but we didn't want to be just investors. We still enjoy building things. So he said, well, how do we invest and build at the same time? We said, oh, that sounds like a venture builder or a venture studio. And we're like, let's do a venture studio. And then we said, well, what's the business model? How do you make money with a venture studio? We said, let's get corporates involved. And so we started to try to develop these different components of our venture studio. corporate consulting with the potential of spinning companies out, building and investing from the earliest days. So that's a bit of a long-winded story, but it's just sort of doing a bunch of different things, building companies, running product, investing, all leads to this model of a venture studio.
Can you describe in numbers, like what is your current state of how many startups have you launched, how much money fundraised, and so on?
Yeah, absolutely. So we started in really the summer of 2016. So it's been about 7 years or so. We've built 9 companies. So the first company we launched really in 2019. So it took us a couple of years, in part because we also raised a fund. So when we started Highline Beta, we have an operating company. We raised a very small amount of capital for it, about $400,000 or $500,000, and put our own money into it as well. Angel investors and people we knew. And so we had a very small amount of capital early on for the business, but we decided to raise a fund. That was always the goal right away. So it took us a couple of years, first of all, to build up the consulting part of the business, the revenue side of the business. Then we raised the fund, which ended up being a $10 million fund. And then we were able to get our first company built and launched really 2018 when we started, and then launched it really in 2019. So we've done 9 companies through the studio. We've also, through the fund, made 9 investments, mostly pre-seed investments in existing startups. So we've done both. Just pre-seed investing in existing companies, 9 in that portfolio, 9 in the venture studio portfolio. And our goal is to build 4 or 5 companies a year.
You mentioned partnering with corporations. Do they involve somehow in the process of building companies, or do they sponsor or pay for the creation of companies? How does it work?
Yeah, our original thesis was let's work with big companies to really identify and validate problems that they have, or more specifically that their customers have, is typically what we were doing, and then validate those problems, and then spin out a company. So recruit a founder at that point, do the work before, then recruit the founder, then build the company adjacent to the corporate so that the corporate could be the first partner or the first customer, maybe sits on the cap table, maybe also invests if they want to invest dollars at that early stage. And the companies would pay us to do that work, and it would lead to a spin out. We've done that a couple of times. But it's a complicated, not surprisingly, it's a complicated and slower process. And we didn't find back when we started that there was a ton of appetite for spinning things out. They loved the idea of exploring new areas, growth opportunities, new problems that their core business wasn't focused on. They loved that idea. But then when we got to hey, let's go spin it out, there was more this inclination of, no, we want to go build that venture in-house. We said, okay, I understand that. You want to own it. You want to control it. You want to have it closer to your core business. We've continued to do corporate innovation work. We continue to explore the idea of spinning companies out, but more often than not, we're actually helping them build internal ventures. And now we're working with So we work with founders to spin companies out or start companies without a corporate partner on day one. Sometimes they have a corporate partner on day one, and it can be a bit of a mixed bag for us.
Do you think that Highline Beta has some differences from other studios? Like maybe you're doing something unique. What differentiates your studio from others, in your opinion?
Yeah, it's a good question. So interestingly enough, we're not a vertical studio today. So Marcus and I don't have a specific industry or vertical that we're focused on or that we love or that we're going to commit the rest of our lives to. We're more horizontal. Now we've got sort of these big thematic areas that we care about. So for example, financial well-being for all is sort of a theme or a thesis that we have. But within that, you can build a variety of different things. You could go into insurance, you could go into financial services, you could go into a variety of different areas. So we're more horizontal. I think what differentiates us is the flexibility in our model as we continue to iterate it. So we don't only source opportunities or ideas from within the studio, do our own research, then recruit the founder, as an example. We do that, but we also source opportunities and ideas from corporates. We also source ideas and opportunities from founders that come to us and say, hey, I have an idea. I want to start a business that does X, Y, Z. So we tend to be a little bit more flexible with the model. Sometimes I think that's a good thing. Sometimes I think it's a challenge because you're taking a variety of different approaches. We also have moved ourselves to a lower equity stake in our model. So like a lot of studios, we've tested different equity stakes. We've taken different equity stakes depending on the circumstances with the founder, and every deal has been a little bit bespoke. But going forward, we're trying very hard to standardize the deal and just say, this is the deal. We think we provide enough value for this, end of story. And so I think that also differentiates us with other studios that are more in the 30, 40, maybe 50% range. We're actually sub 20%. And I'm happy to go into those details. But I also don't think studios really compete with each other. Not in the same way that VCs compete. Again, more and more studios are emerging that are vertical, focus on a very specific industry or a niche. And I think that trend will continue. They'll continue to get narrower in focus. And I actually think that's a good thing. And so if you're building a company in a very specific vertical, you go and you look for the studio that also addresses that need as opposed to a different studio. So I don't think we quite compete the same way that VCs would compete to get into, call it like hot startup investment deals.
Can you tell more about the equity split in startups and about like who are your partners? 2 co-founders, 1 co-founder?
Yeah, typically for us, it's a solo founder. Not always, but typically we start with a solo founder. And then our goal is to try to get the company, an MVP built, and get the company in market with its first few customers, let's say, within 6 months. Now, we also don't only do B2B. We also have done and do B2C companies. So the metrics and the targets and the goals and the benchmarks end up being a little bit different for both of those. But generally speaking, we're trying to go from 0 to 1 within about 6 months. During that time, as we figure out, okay, well, what is this company? What does this founder really need to support them? We would look to bring in potentially a co-founder at that point. Now, if a founder comes to us and says, I want to bring a co-founder right away, we're okay with that, right? Like we have no problem with that, but more often than not, it's a solo founder. And then in terms of equity and deal structure for us, so again, it's varied over the last, since we started, it's been anywhere from about 15% equity to about 25% equity. It's varied quite a bit. Going forward, we're trying to standardize the model. So what we're doing is we're saying we're going to take 10% in common as founders. So we think of ourselves as co-founders like most studios do. We will take 10% for common, consider that sort of the sweat equity value that we're putting in. And then we want to write a $250K check into the company at the very beginning. For that, we will end up taking, call it another 8%. And so, on day one, we're sitting on the and we'll do that as a safe. So in that model, we're at about, and so it hasn't converted yet, but really when it converts, we're at about 18%. And then when we get closer to launch, the goal is to write another $250K check into the company, but bring co-investors. So really at the end of the day, we think of it as how can we be the first $500,000 of a $1 million pre-seed round? So that's sort of how we think about it, but we're sub 20% at the very beginning.
And you end up with 15, 25% in each company, right?
No, so we'll end up, going forward, we'll end up with probably about 18% will be
Uh-huh.
sort of where we'll be. Now, again, we'll invest again, so we'll earn more there, but of course we're diluting, the common, so it might balance. When we invest later on, that second 250K, the valuation there is really determined more by co-investors. And so now we don't know what that sort of dilution or equity position will look like. But the way I think about it is day one of the company, we own 10%, and we've got a safe that, when it converts, will give us another 8% or so. So we're sub 20%, which is lower than most venture studio models. Pros and cons to both approaches, but that's going forward how that model works and how it resonates with founders.
I want to understand, do you invest cash or it is distributed like salaries in your team, which is like this first 250K?
No, it's cash. It's cash. Yeah, it's money we're putting into the company, and we don't take money back for the services that we provide. So we put the $250,000 into the company's bank account, and then we're providing services. The services we provide, really everything from 0 to 1. So we're going to help build the first version of the product. That's design, that's product, that's development. We're going to help with the go-to-market plan and execution. We're going to help them recruit team members once we know what we need for the team. We're going to help them raise additional capital. So we're going to help them do all of those things to go from 0 to 1. And the money we put into the company, really, it's the founder then that has to create a budget and figure out how to deploy the money. But none of that money comes back to Highline Beta. So we don't put in $100 and then say, but you have to pay us $50 for the service. We're providing the service in exchange for the common shares that we're taking when we incorporate the company.
So, and actually the model is to provide services until the company gets a pre-seed round with external investors alongside with you, right?
Yeah, exactly. So that's how we sort of think about launch, right? Which is, okay, you've now got pre-seed investors willing to put money into the company. Hopefully at that point you have a product, you have some traction. We've helped you recruit employee number 1, maybe employee number 2, maybe co-founder, right? Maybe we've helped you recruit your co-founder. You've got external capital plus our capital, also, our second tranche, if you will, of money going in. And now you've effectively, I describe it as graduated from the venture studio. Now, it's very common for us to continue supporting those companies in some capacity because they don't necessarily have all the resources in-house to do all the work that needs to be done. So we might still be supporting on design, as an example, or helping with some tactical execution of growth marketing strategies. We often are still supporting them because they're a portfolio company and we want them to be successful, but they're technically out of the studio and we're not focused on them every single day.
If you're supporting them, do they pay you after this 6 months? No, also no.
No, they don't. We talk about it a lot, and think about how to make that model make sense. We haven't figured that out yet. This is a personal opinion for me, where I've always found it awkward to give somebody money, but then require them to give you some of the money back for services. And I think I understand why people do that. I understand why studios do it. Some accelerators do that as well. But then I always wonder, well, what if they don't want to use your services? What if they don't agree with the rate card that you're charging for them? And I know most people will say, well, we charge at cost, but what does at cost mean? So I've always found that part of the relationship tricky to do. So we haven't done that yet. And then it's really on us to try to balance that with the companies to make sure we're not just working for them forever, because that doesn't make any sense, because we're not really earning more equity or generating revenue for Highline Beta at that point. We're just trying to support those portfolio companies to get them to the next level so that hopefully they can raise the capital to bring in the team so they don't rely on us. And so we don't do an enormous amount once they've graduated, and some don't need us at all, right? I think that's also important. Not every company that we help build comes back to us for months or years after and says, help us with these executional things that cost us money. But some we're trying to just keep supporting so that they can get to that next level.
How many people are in your team?
We're 14 people on the team. A portion, and we're sort of split into two connected teams is the way I think about it, because we do continue to run this innovation consulting business with large companies. And so one of the teams, is dedicated to that. And then there's a venture studio team dedicated to building companies. And there's crossover of resources and support depending on the type of business we're building and the specific support and help that they need. But generally speaking, it's like two separate teams. When we started the company, it was one team doing the work, generating revenue through consulting work and trying to build companies side of the desk, which is a very difficult thing to do, of course, because, as you're trying to build a sustainable business, given the option between building a startup and not making any money or doing this project for a corporate and making money, you tend to go that way. And so we had to get to a place where we could, create dedicated teams to doing both things.
And this cash flow from corporate venture building helps you to cover all costs for the team, or not?
That's right. Yeah. The way I think about it is we have one part of our business that is a revenue generating part of our business, which I think most studios have to figure out and think about, because some have raised lots of capital, of course. That's one approach. But I think others are more bootstrapping their studio businesses, or self-funding them for a while and then saying, wait a second, I can't fund this on my own forever. So I've got to find source of capital. And so we have a revenue generating business and an equity generating business. The venture studio earns us equity. We hope that equity goes up in value. And then those businesses exit, and that generates a return. And then we have the revenue generating business that allows us to have the team and provide the support that we need to the companies in our venture studio.
What is traction of the startups? Like how many of them raised external funding or some rounds, maybe revenue you can share?
Revenue is tricky because it's all, like, again, some are B2C and they're not revenue generating businesses out of the gate. So I think all of them have raised some external capital, but for the companies that are still in our studio, which are very early days, we've got 4 companies right now at various stages of moving through our studio model. Those tend to raise a relatively small amount of money from angel investors. It could be $100K, $200K, something like that, right? So we've had companies graduate out of the studio and raise. I think the company that raised the most capital is actually the one that we've had an exit. And it was actually the first company that we spun out. And so they raised about $6-7 million, I think, and then they exited last year. So in total, I think we're probably in the about 12 million raised. So not a huge amount yet, but I think the one of the metrics we use is equity value created, which is what are the value of these companies, at least on paper. What does that look like? Mm-hmm. And that's now at around $70 million. So still very early, and that's a very conservative sort of, we tend not to juice valuations, right? Like, they raised, we try to be careful about how we value things, especially when it's safes or convertible notes and it's not actually, hasn't converted into real equity. But those are some numbers there.
This exit, did it give you a lot of cash, and did it support your team or first investors? I don't know if you can elaborate about.
The first exit was a company called Relay Platform. And interestingly enough, it was one that we built with a corporate partner. So we built it with American Family Insurance and spun it out, brought the founder in. They raised, I think, 2 rounds of financing, and then exited ultimately to a unicorn called AtBay, which is an insurtech, like a cybersecurity insurtech unicorn. I really don't like the term unicorn, but it's, I guess, you don't want to say billion-dollar company because that sounds like they generate $1 billion. Like, no, they're just a unicorn. But anyway, so in that one, that was both cash and equity in AtBay. So it was not a humongous exit for us, but it was still a meaningful exit, generating returns for the fund. And so, and again, I think this is also interesting for studios. Many of them don't have like a venture capital fund structure out of the gate. And our fund is a typical GPLP structured fund. I think many of them want to go raise funds or will eventually raise funds. Typically, those funds will start off on the smaller side, 10 million, 20 million, 30 million. And that's where I think a studio can be quite effective because early exits, like this company Relay, was around for 3.5 years. That's a pretty early exit. But those types of exits can work very well for studios with small funds, or if they're funding it all off their own balance sheet, as opposed to 200 million or 300 or 500 million dollar funds where you have to return billions and billions of dollars. And so I think early exits plus the outsized amount of equity that a studio typically takes. Again, in our case, about 18%, but others are taking more. When you combine those, the math on returns can be very, very good.
You don't include those corporate startups in this 9, or you include?
No, anything we build with a corporate partner that doesn't spin out, where we're not on the cap table, we don't include. So the 9 that we built, those are all independent companies.
How many have you built with corporates?
2 were instigated with corporate partners. Others, it depends on the definition a little bit of built with a corporate partner. So 2 of them where we really started with a corporate partner with a starting point, did a bunch of work, and then said, okay, let's go and spin out a company. In other cases, we're building companies without a corporate partner on day one, but very quickly starting to work with those partners in our ecosystem. So, an example of that would be the most recent company that we're working on in the studio is called Flora, and they're in the fertility insurance space. We've done a few things in these. Again, we're not super vertical, but we've done a few insurance businesses. And so Flora wasn't started with a corporate partner, but because we've worked with quite a few insurance companies through our innovation work, we were able to start connecting some of those dots and saying, well, we're starting this business over here. Maybe some of our partners would be interested in that business. So not instigated from the corporate partner on day one, but can we, again, connect those dots and create value on both sides? And we've done that. Probably, 3 or 4 of our companies have benefited from the ecosystem of corporate partners, even though we didn't start with a corporate partner on day one.
When it started with a corporate partner together on day one, do they have the majority of equity, or it is completely their own company, or you partner with entrepreneur? Like how the equity split works in this case?
No, yeah, when we're spinning the company out, the equity split. So no, we don't want the majority owning it. And we've had those conversations with corporate partners, of course, where they have that inclination where they feel like they need to own it. But those businesses are difficult to get funded later on. What we've seen, and it also depends if you're in a regulated industry, because some corporates in regulated industries can only own a certain amount of something before, like in banking, let's say in Canada, I think it's like 10%. If they own more than 10%, it starts to become more complicated. So the cap tables, when we're working with a corporate partner and then we're going to bring in a founder, create a new co, the cap, like we're always we want to have our standard deal no matter what. We always want to own the stake we want to own. Then you have to figure out, well, how much does the corporate partner going to get? And that can vary. And that can be, I think, anywhere in my experience from 10 to 30%. So now if you have a corporate partner, they own 30%. Highline Beta, let's just say, we round it up, owns 20%. Now you've got 50% on, call it day one. And again, that starts to get a little trickier for downstream investors. It's still manageable, but those are the considerations when you're building that cap table with a corporate.
Can you tell about the founders you attract? What is the type of co-founders you attract? Criteria?
We're open to first-time founders. And when we look at our portfolio, we do have a percentage of first-time founders. If we're bringing in a first-time founder, we need them to have some amount of domain experience or expertise in the space that we're going to go build a company around. So if a founder comes to us, first-time founder, and says, I want to build a company in the insurance space, but I've never done anything in that space. I'm just fed up with insurance, and I've got to do, that's not going to be good for us. If somebody comes to us and says, I've been in the insurance space for 10 years, I've seen all the problems, I'm fed up, I can't work in insurance anymore unless I go solve this problem. I've never started a company before, but I know where the problem is. I know how to solve it. I need that infrastructure. That's a founder we would take a look at. So we're open to first-time founders. And then, of course, like all studios, or most studios, we're also interested in repeat founders. So, I mean, that's not terribly surprising. So a repeat founder for me doesn't mean they've been successful before. It means that they've got the experience and the scars of what it's really like to start a company from zero and grind almost what feels like endlessly to build something net new in the world. And those founders, if they might have domain experience in the space that they're interested in, and they might not. And if they don't, that's okay. It has to come from somewhere else. So either it comes from us because we've been exploring a space, or again, it comes from a corporate partner where we're leveraging their experience and knowledge and assets in a vertical with a repeat founder. So repeat founders with or without domain experience, first-time founders with domain experience, those are the profiles that we're really looking for.
Am I right that because they have expertise, they always come with their own ideas on what they want to build? So you don't have some ideation process inside?
We do our own ideation in areas that we're interested in, where we think there's opportunity. That is one approach we take. More often than not, at least of late, it's been founder coming to us with an idea. Yes, if they come to us with an idea and they have no domain experience or sort of no right to play, let alone win in that space, of course, people come to us with those things, but those are not companies that we're really likely going to build. So when people are coming to us with ideas, we expect them to come with some of that research and that validation work already done. That doesn't mean we're not going to go do more validation, research into the market, ideation. It just means they got to come with some type of insight, some some insider knowledge that we think is that core nugget that we can build a business around. And so, yes, but again, we'll take ideas from founders and we'll look at those. We'll do our own research and ideation work, and we might build companies that way. And then we could also, again, work with a corporate partner and say, oh, wait, there's an idea emerging from that. We're somewhat agnostic to where the starting point comes from.
Do you think that agnostic approach allows you to check more founders that come to your studio and maybe like to choose some very interesting ideas or very experienced people? Or like sometimes it has difficulties or like creates difficulties that you don't understand this field and everything is dependent on this founder. Like how can you compare this agnostic and vertical model?
I think there are pros and cons to it. For me, the pros are remaining open to opportunity. You never know when the next great founder with the next great idea will be, or you'll have a great idea and find you never know when those dots connect or where opportunity exists. So I think we've remained open-minded to opportunity as we've iterated through the venture studio model. So that's sort of the pro, which is it's always interesting when you say no to something. I mean, you have to say no a lot in this business, but it's interesting when you say no to things where it's like, are we saying no because it's like, no, it does not fit our formula? Okay. Or are we saying no because it's just not a good opportunity? Well, what if it was a great opportunity but didn't fit the formula? It's like, oh, maybe we change the formula a little bit, right? Mm-hmm. Or are we super convinced our formula is right? So that's the pro side. The con side is basically the other side of that coin, which is, well, do you have a plan, or are you just taking opportunities from all over the place and winging it? So it's somewhere on the spectrum from super rigorous, this is our formula, these are our steps, this is our playbook, to we're just going to wing it and see what happens. And I would say, Highline Beta is in the middle of that. I like being in the middle because I like the ability to change my mind, iterate on how we do things, and not say no to something that I think could be really awesome, even if it doesn't perfectly fit how I envision building a company. But it does create more noise, and that can be confusion and that can be problematic.
I meet a lot of agency founders looking into the venture studio model and having difficulties with turning on. And when I tell them the biggest problem of this, like agency turning venture studio, they say, yeah, this is true. And like the problem is that founders that join agency, we want you build the product for us. Let's say it's a development agency. So they are less experienced. It's rare that some successes will come out of this approach when like only those founders who really need development and no one gives money comes to this like agencies, and maybe even they had some experience of taking equity for the services, but they see very not experienced founders. And you said something which I think might be the answer. If like we are looking at the expertise in specific field for 10 years plus, so it might be the answer. Maybe you can comment on like what is your funnel of those founders, and like is this a problem to find experienced or founder with an expertise within specific niche?
I think finding good or great founders is always challenging, no matter what. I think that's just the case. I mean, even look, the success rate of startups, no matter what, is still pretty low. I do genuinely believe it will increase, and we'll see it increase through the studio model. But it doesn't make recruiting great founders easy. That's literally every studio's number one challenge and risk. Because at the end of the day, and I believe this a lot, no matter what a studio does, no matter how much research, no matter how much validation, no matter how much of the services they provide or how much of the work they do, that startup has to leave the studio. And when it leaves the studio, it's the success or failure of that company is basically dependent on the founder or the founding team. Of course, you might still, as the studio, be on the board. You might still be able to influence. But at the end of the day, it's the founders. You're betting on these founders going out there and winning. So that's really the challenge for every studio is, can I find great founders that work well in the studio model? Because there can be great founders that don't want to work in a studio model or butt heads or whatever. So that to me is the number one challenge. And that's true for us. I think it's true for all studios. I think the agency to studio model, I mean, it can work. Look, at the end of the day, nobody has the perfect formula for building companies. I don't care what anybody says. I really don't. Like, you might have a great playbook. It might work fantastic, but you're still going to fail a bunch of times. That's just reality. If we had a perfect formula, everybody would have just copied it and everybody would be winning, which makes no sense. So I think agency model can work, but the risk that you're highlighting is a real one, which is a founder's coming to that agency and saying, I know exactly what needs to be built. It's this, and I want you to build it, and I will exchange equity, because I don't have the cash, I'll exchange equity to do that. That's a tricky thing. It's not about maybe the experience of the founder. It's almost just how rigid they are in what they believe has to exist. And so then you as the agency have to really believe that that thing is going to work. Now, if you can pull that off with a high volume of startups, like a big portfolio, then it doesn't matter, right? Because if you can pull that off, do 30 of those a year, I don't know, 5 of them will work, and that math probably will make sense for that agency. But if you can only do that 3, 4, 5 times a year, you really got to make sure you know what you're doing. And the building of the technology, although sometimes difficult, is not usually the biggest challenge.
Yeah.
So it's like, cool, you built it, but I need customers, I need more capital, I need a team, I need a whole host of other things that are actually, in most cases, higher risk. Maybe not in deep tech, in certain verticals, but in most cases, if you're building B2B SaaS, let's face it, the building of the thing is not the riskiest thing.
In your studio, you first find customers, get revenue, and then build something, or do it simultaneously?
If we're doing B2B, I don't love the term design partners. I think that just shows maybe my age. It's like, I don't know when when a beta customer became a design partner, but anyway, I'll use the term design partner. So ideally, if we're going B2B, we've got letters of intent, LOIs, from design partners that basically say, if you build this thing, I will pay you this money. And I'm, of course, willing to give feedback and iterate with you and figure out if this thing makes sense. So that would be the first step before we go and rush out to build something. Because again, the building of the thing is not usually where the big risk is. Like, it's rare we would come back and say, we can't even build that solution, it's impossible. No, it might take a little bit longer, or we might go down the wrong road with it. But really, it's like, we don't want to build, ship, launch, and then it be crickets. I've done that, by the way. Like, I've lived that experience before. And so for me, certainly B2B, LOIs first. B2C is a little bit trickier. B2C, you still try to do that, but you'll often have less commitment. So you might have a wait list, as an example. Maybe people have pre-purchased. Maybe you've proven that they'll go all the way to put their credit cards in, as an example, on something fake that doesn't exist, to give you the confidence that if you build that thing, people will in fact convert to it. So you try to de-risk and validate as much of those key assumptions up front before you go into build. And then in my mind, when you go into build, to some extent, you just put your head down and build, because now it's just about the speed with which you can get the first version of this thing done that you believe is going to create value. And so that you can get it out to those customers and then keep iterating and learn, because version 1 is not going to be fantastic anyway.
Do you think there is some way for development agencies to partner with studios who are doing marketing and sales, and to be like second partner? For example, like you take some 18% equity, let's say, and then there is a builder studio which joins in, let's say, after 4 months, 6 months, when there is a signs of product market fit, or at least like interest from customers, to create MVP and then develop the product. Do you think this model might work, or it is not? And how development of the product is organized? Is it in your team, or you work with agencies, freelancers, or it is like in the startup inside, so they hire some developers or engineers?
Yeah, I think to the first part of your question, I think that absolutely can work. The way I think about studios in general is your job is to bring more of the ingredients to the table than less. It's just as simple as that. If all you're bringing is a dev team, then you're a dev shop, and that's totally fine. If all you're bringing is capital, then you're an investor. That's also totally fine. But if you can bring the combination, and you've got the design partners already available, like you're working with a corporate, let's say, and you've got this reason. So how do you bring all of those resources to bear? Because the argument on the studio side is like, we're going to bring more ingredients to the table so we can get something built that's going to work faster. That's the whole point. So I need more of that stuff. So if you've got a studio that doesn't have the dev capabilities you need to build, let's say the MVPs, then you find partners and maybe they get some equity, maybe they get some cash, and you find those fast moving dev shops who are experts at building products, and you partner with them in some way so you can bring that as an ingredient, as an asset to the founders that you're working with. So I absolutely think that can work. In our case, again, like speaking to Highline Beta's flexibility and open-mindedness, we've built some things completely in-house or almost really completely in-house. We've brought in freelance developers, and we've worked with dev shops as well. Because when we start, working with a founder, we may not even know what the solution is. So we might not know, well, what are the best resources to deploy? And in a studio, it's tricky to have a big bench. I can't have 10 developers on staff waiting, all with different types of experience, because the different types of companies might need different things. So, when we need specific extra resources, we can bring those resources in through freelancers, dev shops, agencies, or whatever the case may be.
You shared about importance of creating cash flow, but maybe you can suggest some topic that we can delve deeper and you think is important for all potential venture studios or existing venture studios?
Yeah, I think one of them that is interesting is how do studios scale? I don't think that that's obvious or clear, and I think there's a variety of ways that studios will scale. And we heard it actually in the virtual event that you ran recently. Each studio sort of taking a slightly different approach to how they think about scaling the number of companies that they're creating. And also the way I would think about it is like assets under management. So the dollars that they're able to then deploy, not just, let's go build from 5 companies a year to 50 companies a year. That's one part of how to think about scaling the studio. And then the other is, how do I deploy more capital? A lot of studios are starting and they're not thinking about scaling, but the ones that are established are all thinking about, how do I scale? Do I keep building 4 or 5 companies a year forever? Is that the play? Does that make sense? And I sort of think about it in, 1 year, 2 year, or 3 year chunks. Oh, that's a portfolio of 12 companies. Now I need the capital to go do another 12. And I just do them in sort of batches. Or am I thinking, how do I get from 5 companies a year to 10? How do I get from 10 to 15? And I think that's...
What is your vision about scaling companies?
Yeah.
about scaling venture studio capacities.
It's such an interesting topic, and I definitely do not have the answer. And this is, by the way, I think what makes ventures. So I will answer the question, but this is what makes venture studios interesting, but also challenging. I think there is a need, and we've heard this now, to try to standardize some of the language around venture studios. And I think that's important as an asset class, because otherwise investors can't compare apples to apples, founders can't compare apples to apples. So I think that that's important. With a caveat, which I will add, which is as venture studios emerge and more come into the market and more of them experiment with how to build companies, I think there's value there as well. I think studios will start to fade when everybody follows the exact same cookie cutter approach to building companies. That's in fact why studios are growing, because the venture capital model, which by the way, we all rely on to some extent, like we all need these companies to raise more money, but there's this push that says, is the venture capital model right? Is that, like, it's pretty formulaic. Does that make sense? Well, what if there's a new way of doing it? And I always think, cool, I do it in one way. Another studio does it a slightly different way. What's the next innovative approach to build it? I don't know. But that's why I don't want studios to get so cookie cutter and so perfectly defined that's like, oh, sorry, you don't follow those 10 steps, you're not a venture studio, get out of the community. That will be a mistake if that's the approach that we take. So with all of that sort of preamble, the way we're now thinking about scaling is, so we do want to build 4 or 5 companies a year for the next 3 years. We think that that's a nice portfolio size and doable. I think to scale and sort of get to the next level, Highline Beta as a holdco, as a platform, has to create vertical studios. So that's, I think, going to be the next step for us. I think we're going to see more verticalization in studios. And to me, that's actually pretty important from a differentiation standpoint, is to say, I think studios are going to get narrower and narrower. And I think that that's going to be appealing to certain investors, to certain founders, where you're like, that's my group. If you're building a company in this very narrow space, the only way to do it is with me. And so I think that's the next step for Highline Beta's model, is we scale by bringing in partners. Those partners can run, who are domain experts in verticals. They can then, you put a small team per sort of vertical with shared services below that. So you sort of imagine these pillars sitting on top of Highline Beta's platform, specific verticals and areas we're interested in, bring in a partner, and then bring in the capital, probably into the opcos of each of those entities. Maybe funds emerge for each of those as opportunity or follow-on funds. But that's really how we're thinking about taking Highline Beta to the next level, because I don't think horizontal long-term really makes sense, but horizontal is interesting because, again, it keeps you open to different approaches, which, by the way, might have to change per vertical. I'm not convinced building companies, like OSS, by the way, which you interviewed the guy there, I thought was amazing. I was like, what an awesome model. But how you build companies there is not necessarily the same way you build them in health tech. Maybe, but I don't know, is that a guarantee? So I don't know that you can take your playbook and just, copy and paste it across verticals. So now I need partners with expertise and flexibility in the platform to design slightly different versions of a studio across different verticals.
This is super, Ben. It gave me so many new thoughts, like what you said just. I like that this idea that it's not bad, it's not a bug, it's a feature that all studios are different. I think that, of course, many studios, investors, and founders will benefit from some standards like safe for Y Combinator. So if there will be some simple document to fundraise into a studio, or to agreement between a studio and a founder, and some just input 3 different numbers. What is your equity split? How much money do you invest? And it's very simple and understandable by each. I think they will benefit. At the same time, entrepreneurs are so creative in this field, so they try. I saw maybe more than 10 completely different models regarding taking equity, options in company, attracting founders, so different kinds of founders, different models, and I think it is very healthy that many studios are different.
I do think simplifying some of the concepts, that's important. I know there are studios that obfuscate deal structure and have maybe overcomplicated deal structures that the founder comes in and says, how does this work? What do I have at the end? I'm not quite sure, how that's all going to play out. And so I do think very simple terms, simple deals, but I think a lot of studios are still iterating on what their models look like. They're not complicated because maybe some are complicated because they want them to be that way. And I think those studios will die. But I think it's complicated because people are still trying to figure things out. And then we're like, okay, that makes economic sense for us. That makes economic sense for you. Great. Now I can simplify. That's why we're, again, trying to standardize our deal structure, because every deal ended up being a little bit different. It's like, okay, that's not the end of the world, but it probably should just be standardized, and we can stick to our guns and founders can stick to their guns. And I'm like, that's okay. So I think simplification, standardization of certain things, but I agree. I don't want to lose the variability in a studio. And if you think you can build a studio in a vertical and own this and do it that way with those assets, it's like, I don't know, like what do I know? I'm not, again, if I had all the answers, I would have built more companies that would have exited for $1 bazillion. Like nobody has those perfect answers. And what works for one person or one studio is not necessarily going to work for another. So I think there has to be, I called it like different flavors of ice cream. Like most people like ice cream, but I like chocolate, you like vanilla. Okay, that's fine. That's okay.
When you said that, ideally we want to build verticalized studios like pillars, and we have a platform, Highline Beta. And now I meet also like some founders of studios who are launching their like meta studio or whatever we'll call it. My thought now is that studio founders first, most of them probably have something like, maybe at least me, I have this. I'm not sure about other, but I'm looking through my prism, how to say, shining object syndrome. When you have ideas and you want everything, so like you are greedy to take like, oh, I have this idea, I want this company. I have this idea, I want this company. Right. And first of all, like first wave of studios is like greedy people taking a lot of equity and pursuing many ideas. And then there are some studios which understand, okay, we have some vertical, or we have some like launching 5 startups a year. We want more, and we want to become not only launch startups in parallel, but we want to launch studios in parallel.
Yeah.
So I have a hypothesis that studio founders have this shining object syndrome, and right. They're very greedy.
I think I'd like to believe it's ambition and not greed.
Yeah.
That it's how do you scale this model? We know in venture capital, the way that model scales is assets under management. I start with a small fund, then I raise a bigger fund, then I raise a bigger fund, then I raise another fund next to that fund, because the business model is management fees. And that's fine, right? It's like, some people don't like it, some people do, whatever. Wherever you stand there, that model is well understood. If you want to scale there, you have to build bigger funds. The studio model's different. You don't necessarily have to build bigger funds, because most of the companies that you're building from zero are capital efficient, right? Doesn't cost you tens of millions of dollars to launch a business. But I think most people who figure out a model that feels like it's working want to figure out how to do more of that model and scale it. That's probably, I think, maybe less greed, more ambition, and probably a little bit chip on the shoulder. Depends how big the chip is, not a potato chip, like a chip. But it's probably a bit of a chip on the shoulder, which is, maybe they were rejected by investors a lot, even though they were then built a successful company. Maybe they feel like they have some insight or inside knowledge of how to build companies better, and they want to realize that and expand it, So, but I think scaling the venture studio model is a whole big challenge unto itself. Like it's not going to be easy for people to do, and some are doing it, right? It's mostly through raising of capital. But I don't think that that's necessarily the only way to do it. But it's going to be interesting to see how that happens. So, and by the way, when I say vertical studios, I don't mean 10 vertical studios, right? I mean, like, could we even launch one in a vertical with one partner that runs that? Because I think you're right. I think a lot of founders have shiny object syndrome. They're just chasing things like that. That's dangerous. And then as you do that, you lose whatever competitive or unfair advantage you had from where you started. You started from a place you're familiar with, in an industry or a vertical or a playbook that you're an expert at using, and you say, "Oh, let me go chase that." And you think, "Oh, I'm smart. I can win in that space." And then usually you get your ass handed to you when you do that. So growing the studio model from the core is tricky. You've got to bring in really great people that can also, take that ball and run with it and have the experience needed in those specific verticals.
Maybe one clarification about your fund. I assume that your fund is dedicated to invest in like 16 companies or something, and like 500k. So you have this fund, you launched 9 companies. How many failures you had? How much companies you had and invested? Like, how will you launch more 7 companies or less?
We've had so far no failures, which is good. That's not suggesting there won't be some failures, but so far, no failures. Our current fund we may do one more investment out of our current fund, and then whatever we have left will just be follow-on for our existing portfolio. Mm-hmm. And then again, like speaking to how these models scale and how studios fund themselves, at some point we will raise a second fund. Our approach is really focused on investing in the companies on day zero through our holdco, through our opco off the balance sheet. So that's where the first money will come from. And then ideally we're able to raise a fund, so we're able to use the fund for the follow-on capital. So that's sort of how we think about it. Start with the operating company. It's the first investor in every new company we create. And then we have a fund, let's say fund 2 sits on top of that and sort of is the follow-on capital, and then maybe can invest, depending on how big that fund would be, can invest a little bit further. So that's structurally how we think about it. And you see a lot of studios with a similar model. They have an operating company, holdco, and then they're building a fund next door to it. Yeah, so fund 1 is essentially finished. And again, there's some dollars in that fund for follow-on, and then we're going to have to go raise more capital to be able to continue to fund the next batch of companies we do. And again, for us, it's 4 or 5 companies a year is our target for the next, call it 3 years. Although if we do manage to build, and I think we will probably find a way to launch one vertical studio in the next year or so, then ideally it would have its own capacity to build, call it a couple of companies to start.
Super. Ben, thank you very much for the interview. Very interesting and insightful.
Awesome. I appreciate the time, Max. Thank you.